In addition to the fact that the sustaining capital investments have gone unmade, now we need to replace all the stuff that got destroyed in the war. We need to replace 2 of 7 natural gas trains in Qatar. We need to replace Karg Island in Iran, which we effectively destroyed. So the problem's worse. That problem won't show up in 2026 or probably 2027. Towards the end of 2028, 2029, you can't make up for 5 years of deferred sustaining capital investment, several $1 trillion. You can't make that up in a year. You can't do it. It's physically impossible.
So with that in mind, is now a good entry point for oil stocks? I had Lobo Ticker in here. He just bought an oil stock after waiting for quite some time.
I'm buying them now. I think they go lower. I think that we're going to see free cash flows in the oil sector in the next quarter to be markedly lower. I think the costs of producing oil are increased by inflation, but the price that they will receive for oil as a consequence of declining crude prices will fall. So I think the oil stocks fall from here. I've learned in my life, Charlotte, that sometimes stuff is cheap enough, and the fact that it might go lower is not a reason for me personally to defer purchase if I think I'm right 3 years from now or 4 years from now. So I'm a buyer.
You're a buyer now of the oil stocks. I remember in May you were pretty set up, except for that one highly speculative subset. So have you been able to get in on those at this point?
I haven't filled myself on that subset, but I won't name the names. I will say that there will be a speaker here this year at this conference, Keith Hill, who probably will name the names. Keith is my offshore exploration guru. I've followed Keith Hill's lead for 30 years. He ran the emerging markets offshore business for the Lundin family, which is a wonderful apprenticeship. He's a superb human being, and I've recruited him to speak here this year.
Okay, well, so that will be a reason for people to maybe pick up the online tapes that will be available. All right. Well, looking beyond oil, I remember also last time you said you were underweight the sub 250 million market cap explorers and developers, and you'd be looking to deploy capital there over the next 90 days or so. So curious for a status update there.
I'm still working on that.
Yeah.
I think they get cheaper this summer. I believe the gold price and the copper price stay fairly soft in the face of a fairly strong U.S. dollar, so I have time to fill it out. In the meantime, at least 2 different drill holes really caught my attention. The Mogotes drill hole in the Puni district in Argentina, stunning drill hole in a wonderful district, and a drill hole drilled by an honest human being, which means that even if it was down the throat of the deposit, it wasn't intentionally down the throat of the deposit. And then the Aras, A-R-R-A-S, drill hole in Kazakhstan. These porphyry drill holes of this caliber occur extremely rarely. And the idea that I got 2 drill holes within 2 months that are world-class drill holes, it's too early to tell whether those are 2 mines. One drill hole does not a porphyry make, but they're both, potentially portfolio-changing drill holes. So a lot of the money that I would put in the market in general, I put into 2 drill holes in particular.
Okay, so early days, but we'll see how that plays out. What do you see as the main challenges right now for companies that are in that category?
None.
This is one of the biggest questions facing investors right now. If interest rates eventually fall because of political pressure, what happens next for gold, the US dollar, and your purchasing power? We'd love to hear your perspective, so drop a comment below. And if you enjoy this kind of macro investing analysis, consider subscribing for more.
The main challenge is that most of them are valueless. They're run by stupid people, and they have bad properties. For the subset of 10 or 15% of the companies in the sector that are well run, that have decent properties, life is great. It's tough to finance a bad company in this market. So people think that money's tight, but bad companies should never be financed. Good companies, as is evidenced by the fact that the private placement market is issuing no warrants, it'll tell you that money is freely available for good people with good projects. I'm regarded as a high-profile investor. People tell me that my presence in a private placement is helpful. I was cut back in the Aras placement. In the good placements, there's a lot of competition from check writers.
Very interesting. So they just need to have something good going on, and they should be okay.
It shouldn't be too much to ask, right?
Yeah, if only. All right. Well, I want to take a look at gold as well. We talked last time about the impact of the Iran war. This was making the US dollar strong. So you explained how that was going on. I've been hearing about this as kind of a main factor weighing on gold. Would you say that's the case?
Yeah, I think the Iran war is less important now than continuing high nominal interest rates. Capital markets believe that the new chairman of the Fed, Warsh, will be a hawk on interest rates. And I think he will as long as he can. But I think the fiscal reality of the United States is that the political class will lose their courage, much like they did in 1975. And as continuing high nominal interest rates impact the debt service capabilities of the U.S. government, impact the bond market, and impact credit-constrained consumers and credit-constrained industry, that Congress ultimately will exert influence on the Fed to abandon the hawkish tendencies and lower the interest rate. When that happens, the savings class in the world will note that the political class in the United States abandoned the sanctity of the US dollar in favor of domestic politics. And then, and I'm not saying this will happen soon, but 6 months from now, 8 months from now, it'll be off to the races.
Yeah, I think that's what a lot of people are wondering right now. At least I see a lot of questions about this is, okay, we can accept that gold is maybe going sideways for some period of time, but what's the factor that breaks us out of that? Is that how you'd see it?
Absolutely.
Yeah.
You may not recall, but in previous interviews between you and I described the epoch of 1975, and it's instructive for your listeners who didn't hear that interview to understand that in the period of the 1970s, the gold price, as a consequence of inflation and negative real interest rates, ran from a low of $35 to a high of $850. In the middle of that move in 1975, U.S. Congress allowed U.S. interest rates to rise, which broke the gold price, broke it from $200 to $100. The gold stocks did worse. At the end of 1975, because it wasn't just the gold price that broke, the bond market froze, the equity markets went down, Congress lost its nerve. When Congress lost their nerve and forced interest rates down and forced liquidity into the market, the gold went on a romp that began at $100 US and ended 5 years later at $850. What we're seeing is a hiatus, perhaps not of the same drama as 1975, but we're seeing the same interest rate related drama now. And I think the resolution's the same.
So for people who are worried, a couple of weeks back when gold went under $4,000 per ounce, what would your response be?
Sell it to me. If you're worried, when in doubt, blow it out. I'm not worried whatsoever. I'm concerned about the maintenance of my purchasing power in US dollars. There's been one asset class that has defended savers against the depredation of their currency for a long time, and that's gold. I would prefer to have it.
All right. And, for gold, when it comes to the gold stocks, which ones would you say have the most upside right now? I remember we talked earlier this year about how you had been buying some of the larger companies. How are you seeing that?
That depends on who you're asking the question to. If you're asking the question to Rick Rule, somebody who spends a couple hundred hours, 400 or 500 hours a month studying stocks, he can afford to be much more aggressive. I can afford to take risk in favor of value add. When you talk to most investors who are willing to spend an hour or two a month on their stocks, they should own Franco-Nevada, Wheaton Precious, and Agnico Eagle in that order. And they should stop. They should play with their grandkids. They should read a book. They should play tennis or golf. They're going to do fine. The market beta, defined by me, is the amount by which the gold market outpaces the broad market, will be sufficient in the next 5 years that buying those three stocks and then resting the rest of the time will work fine. I suspect that people who listen to Charlotte McLeod are people who are willing to do more work and take more risk. In their case, I think the themes that they need to look at are takeover candidates. And again, who they buy, what part of the takeover market they participate in depends on the level of risk they're willing to take. There are intermediate gold producers, the B2 golds of the world, the Oceana golds of the world, who are selling at substantial discounts by most measures to their larger peers. Either those discounts disappear or they get taken over. That's a lower risk way to play the game. Single asset producers are always viewed by the market as riskier than multiple asset producers. You eliminate the single company discount when a larger company takes them over. So if you're willing to take a little more risk, then you go to the single asset producers that are likely to get taken over. More risk, development stage companies. They trade at a discount to net present value until they can establish the viability of the net present value. If a producing company takes over a non-producing company, a lot of that discount goes away because the pipeline is assumed. The greatest premiums of all, of course, will accrue to the advanced explorers, the Ruperts of the world, that are trading at 20% of NAV.
Notice how the conversation is shifting from simply owning gold to identifying where the biggest opportunities may emerge. In strong commodity cycles, stock selection often matters just as much as getting the overall market direction right.
If somebody buys Rupert for 50% of what it's worth, you have a double in the price, and the acquirer still gets the asset at a discount. So the answer to the question really depends on who the person asking the question is.
Yeah, well, I think that hopefully our audience are people who are willing to do some more research, but it's good to have the full spectrum. I wonder if you can say a little bit more about what you see coming for M&A in the precious metal space. I think we've seen quite a bit of it so far, but what do you see coming?
Next 2 years is going to be wild. Just
right.
Absolutely wild. The most informed money in the sector is the sector itself. And the mistakes that individual and institutional investors make are not mistakes that, for the most part, the industry is going to make. The industry, while they won't always get it right, will get it more right than the investors will. And value anomalies in the market will be arbitraged out by the industry before the investors arbitrage it out. Rupert was obviously a strategic asset to Agnico for 4 years before Agnico bought it. The investors had lots of time to act, but they didn't, so Agnico did. And you're going to see that repeated. And there's going to be a couple kinds of mergers. There's going to be strategic mergers, where Agnico looks, as I'm using Agnico as a subject now, where Agnico looks at assets that increase their leverage in a given district, where they can utilize existing producing assets and amortize them over more assets. Then there's also going to be tactical mergers, like the merger between Equinox and Orla. No strategic benefit, but rather combining two with size and scale gives them larger market cap, higher trading volumes, more index inclusion, and more passive ETF buying. You're going to see both of those, and you're going to see it in spades.
So to what extent are major miners, major gold miners, are they just deciding now this is how they're going to grow is by acquisitions? They're not really pursuing exploration. Is that what we can accept at this point?
They're starting to loosen up with the exploration budget. It has occurred to them, beginning really 5 years ago, that their exploration pipeline was empty, and they need to fix that. It's still empty. Right now, Wall Street and Bay Street still remember the decade 2000 to 2010, the incredible misallocation of capital that the industry was guilty of. And they're holding the industry to a very, very tight leash. That's going to change because by underinvesting in sustaining capital and new project investment, what most of the mining industry is doing is sterilizing their cash flows 4 or 5 years out. In 2 years, the industry is going to be asked to be sustainable and to emphasize growth. Given that they have no pipelines, the only way to do that is to buy. There's no other way. It's too late.
Okay, so that will be a trend that we can keep an eye on as well. Of course, we have to bring up silver. So when it comes to silver, are you still favoring the silver stocks versus physical silver? Yes.
Yeah. I mean, listen, as you know, I made a fairly widely publicized sale of silver. Did not sell at the top. Let's get that done. But I did fine. And any hyperbolic chart I sell, I just do that. The silver stocks, at the point in time that I sold my silver, discounted sharply lower silver prices. The silver stocks are still discounting lower silver prices. If silver goes up, the silver stocks go up probably more. If silver trades sideways, the silver stocks can still go up because they're priced as though silver were cheaper yet. If silver goes down, the silver stocks fall less than silver does. Juxtaposition between the two asset classes in terms of their suitability for a speculator are silver stocks, and silver stocks.
Well, and I wonder, is there a circumstance where you would say, okay, it's time to buy more physical silver? I assume like hate is the circumstance.
Hate's it.
Okay.
If I looked at the public comments to this interview on YouTube, and people said, what a moron. Like, why would he buy silver? This guy's dumber than dirt. If I saw a preponderance of negative sentiment around silver, a vituperative preponderance, I'd buy it. The last time I bought silver, if you looked in the social media comments around silver, people were either bored by it or much more commonly they hated it. That's very bullish. It means that everybody who wants to sell has already sold. That's why they're making vituperative comments against it. At $20 silver, there was so much hatred that the only thing that had to happen was the hatred had to dissipate. That's it. Nothing else had to happen. And that's what did happen, which is why I sold my stock. Or why I sold my silver, pardon me.
Yes. So what I think I asked this question recently. What is hated right now? And at the time, there was
nothing.
Still nothing.
Nothing. I would say there are regions that are hated. Were I not a U.S. citizen.
One theme has stayed consistent throughout this discussion. Long-term investors are often rewarded for buying quality assets when sentiment is weak. Whether you agree or disagree, it's a reminder that patience can be one of the most valuable tools an investor has.
And occasionally I flirt with becoming not one. I would likely be speculating in Iran. I would likely be investing in Russia. What is hated now is places. So Congo is still hated, despite the fact it's treated me marvelously well. Most of Africa is hated. South Sudan is certainly hated. Bolivia is hated. Myanmar is hated. So there are places that are hated. And there are sectors that are at least unloved. Offshore oil and gas exploration, non-shale, non-basin-centric plays, still hated. Particularly offshore exploration in countries that most people can't pronounce.